Hello and a warm welcome to Econoday Unplugged on Tuesday, the 12th of January 2021. Mark Penders across the pond stateside. I'm Jeremy Hawkins here in London. Well, I suspect no one's surprised that politics continue to be dominating the headlines, at least since the turn of the year, and that looks unlikely to change anytime soon. Still, the economic data keep coming, and there have been signs from both sides of the Atlantic that the near-term outlook for economic growth is a good deal weaker than seemed likely perhaps just a few months ago, certainly before the second wave of the virus really took off anyway. So let's have a look at where we stand at the moment. Mark, I guess it's fair to say that last Friday's US employment report left much to be desired. So was it a one-off, or are we to expect more of the same over coming months?
Well, if you look at the graphs, it looks like we should expect more of the same. I mean, this ended 7 months of employment growth in the U.S. It was lower than expected. The Econodays consensus was moving lower through the week, starting out at about 100,000 gain, and by the end of the week, looking for 50,000 gain, and it came in at 140,000 contraction, which was well below the low end, even the most pessimist, the forecast in our sample, which was 50,000 contraction. So it was a very unpleasant report, and we just got JOLTS report today. It's Tuesday, and that is counting job openings in the month of November. The data I was just talking about was for December, and 6.5 million job openings coming back down, and it hasn't really moved anywhere. And so that's another negative. Apparently, employers are saying that they're having difficulty finding people to fill their positions because of COVID concerns among the prospective employees, and also inability to get daycare. This seems to be a very important issue, and these are all COVID-tied problems. And I think what we're going to have with the new administration coming in is going to be another round of stimulus. A lot of Americans just got their stimulus checks, which for the very, very needy will delay evictions and will help, feed them for the next few weeks. But then after that, there's going to have to be another round of public support. And at the same time, immediate COVID effects are not relenting, and the vaccine rollout isn't having an impact yet. And so the medium-term outlook, over the next several months is definitely not very favorable.
So can I ask you, over here, I'm sure you're aware, the COVID numbers have been really bad, and economic forecasts are being sort of, ground lower and lower as we speak. Is there any talk about a possible return to negative growth, your side?
Yes, for the first quarter contraction, that is definitely at risk right now, and we'll have to see how the fourth quarter plays out. Those numbers are still coming in. At the end of the week, we'll get retail sales for December, of course, and this will be the definitive judgment on holiday sales, and it's hard to see exactly what we should expect. Contraction is a possibility, at least a marginal contraction. Yeah, and also growth could also be possible there too. But these are also going to be lifted, at least to a degree, by the emergency stimulus efforts. And if you didn't have those, we would be the U.S. would be in not a great position at all. Now, you did, however, Canadian employment report, which was also on Friday, and just looking at it, to me, it seemed pretty much the similar story to the U.S.
It was, as you say. Canada came as a bit of a surprise. I think looking around the sort of G7 group of countries anyway, Canada's been holding up pretty well and by and large outperforming a good chunk of them anyway. But certainly in terms of December, the employment number was down almost 63,000. And that came as a real surprise. The market consensus was a decline, slightly less than 30,000. So it's more than double that. But it's got to be said that, when we look at some of the breakdown of it, it's not quite as poor as first appearances suggest. I mean, part-time joblessness went up a lot. I mean, jobs there fell almost 100,000, but full-time employment continued to rise. That was up very nearly 37,000. So although we did see a decline in the participation rate, which may perhaps suggest that workers are becoming that much more discouraged, it's not a great report, but it's perhaps not quite as soft as first appearances suggest. I think that kind of view is backed up by the Bank of Canada's business survey outlook, which we had out yesterday, Monday, which really came in at quite strong. I mean, although it did suggest that current activity, particularly the likes of retail sales growth at the back end of last year, was weak due to inevitably COVID effects, businesses have become much more optimistic now about prospects for 2021, to the extent that they're now expecting to start employing again, as opposed to some kind of shakeout we saw at the back end of last year. They're also seeing a fairly sharp improvement in investment intentions as well. So the overall picture for 2021 looks at least a good deal brighter than it did in the last report 3 months ago. Now, of course, this is still very much expectations based, and we'll all have to see what happens to the COVID numbers and how the vaccines work out. But at least taken at face value, things look a little bit better. And I guess that'll be reflected in the Bank of Canada next week, when they probably won't do anything.
Well, that also brings me back to the U.S. Report, because there was also signs of strength in that. The weakness was concentrated in nearly 500,000 decline. That's 500,000 jobs lost in leisure and hospitality.
That is a big chunk.
Is a big chunk.
Yeah.
But if you were, if you're in the professional or in this in the business services, they did well. If you're in the sciences, they did well. But and this is reflected in average hourly earnings, which shot higher as these low-end, lower wage jobs just were destroyed en masse. And in any case, it's even though you're getting a separation, you can't really have a cohesive economy or a cohesive social structure if you have the lower end workers just being decimated like this.
Yeah, that's right. And I think that's certainly been one of the interesting aspects of what happens to the European economy this year. I mean, it's the same boat here again. I mean, people just desperate to try and get this vaccine delivered as quickly as possible. But where we do have government support programs in place which are due to expire, I mean, for my own part of the world in the UK, the current furlough scheme is presently scheduled to be terminated, I think, at the end of April time. That's going to be when things start getting really interesting in terms of what happens to the labour market. And it may well be that we see, as we've seen previously, some of these support schemes extended yet again, or somehow there's going to be additional help elsewhere in the economy, or even through the central banks to the extent that that does anything. You mentioned, sorry, yeah.
Well, update us on the status through Europe of lockdowns right now.
Yeah, okay. Well, basically, it's grim. I suppose the good news in overall picture is that the new COVID infections are declining pretty well everywhere. The UK is a bit of an exception, but at least even here it looks like they've topped out now. Now, as folks probably recall, because it's not just UK now, it's certainly right across Europe and in a big chunk of the world, but it's been this new COVID variant which has been transmitted so much more quickly or efficiently, whatever you want to call it, than the old version, which has been causing these numbers to go up so sharply. But what it has mean is that, as mentioned earlier on, expectations for growth are being steadily downgraded because of lockdowns and the like. Earlier on today, there were some reports coming out of Germany, which only, a couple of weeks or so ago, extended its current lockdown. It extended that through to January. Now there's talk apparently that Angela Merkel is warning that they could have another 10 weeks or more if there's no improvement or additional improvement in these COVID numbers. We still have very tight measures in Italy. Spain would appear to be on the brink of another lockdown as well. So I mean, put all this little lot together, the signs are that first quarter Eurozone GDP is going to be potentially negative. It's certainly going to be weak. Fourth quarter from last year, Eurozone GDP is expected to be negative. So it could well be the case that continental Europe as a whole now, we're talking about the prospect of a second double dip recession. because for the UK side of it, expectations strongly for negative growth in the fourth quarter, and we'll get a November update, monthly GDP update on Friday, which is expected to see the first decline since back in April, so during the first wave of the virus. It really does. Things are shaping up quite nicely over here at the moment. And just to highlight it, so you talked about the retail sales on your side. Well, we've had November retail sales. As ever, we lag somewhat behind what's going on in the States. But November retail sales for over your Eurozone were down almost over 6%, and that's the worst we've seen since they slumped almost 12% back in April time.
And that's a monthly.
Sorry, I should say, yeah, that's a month-on-month number, and also,
is that a volumes?
Yeah, I'm going to say, because it's Europe, it's volumes, so it's not even nominal numbers. So we're talking about a real sharp downturn there. And looking across the countries, I mean, you've got to say that would have been significantly worse, but for Germany, although they're clearly very concerned about the COVID numbers out there. I mean, retail sales in Germany actually rose almost 2%. And as of November, they're more than 8% above their pre-pandemic level in February. But if you look elsewhere amongst the larger economies, I mean, Spain versus Feb is down, about 4%. Italy is 7% down. And France, which saw an 18% collapse in sales, in volume sales in November, they're now down almost 14%. So really what growth we did see, during the latter stages of last year is just been, fitted away by these new lockdowns which are coming through. And so had it not been for Germany, which saw a near 2% increase, the actual, drop of over 6% would have been a lot worse. But with Germany, as mentioned earlier, potentially increase, lengthen its lockdown, it really doesn't bode at all well for the way these numbers are going to come in over the next several months.
Well, let's talk about France now. France, did they have those sales numbers in November were very poor. Were they in a big lockdown in November?
Yeah, they were. They introduced a very hard lockdown then, and I think as you go across Europe, I must say there are different types of lockdown in place. Everyone tends to refer to a lockdown as a lockdown, but some, if you like, are a good deal tighter than the others. But yes, France went into a full-scale lockdown in November, which, as I say, saw its sales just go down the proverbial tubes. Now they did ease some of their measures in December, but such have been the numbers coming out of France, the COVID numbers, which have been astronomically high by their standards. The easing in lockdown numbers has just been very, very mild. So it may be you get a small bounce back in sales coming through at year end, but it won't be enough to wipe out the damage which has been done by November. And chances are it'll just be short-lived anyway, because there's talk about even more measures coming in, beginning of this year. So all in all, it doesn't look too good. Now, of course, we've got an ECB meeting next week. They've only just announced their last easing package in December time, so it's pretty hard to see them doing anything. But I guess it's the bottom line is that, again, everyone's hoping the vaccine can be rolled out as quickly as possible. And at the moment, the signs are that most of Europe is running at least somewhat behind target on that front, which raises the risk of fresh lockdown fatigue, which causes people just to throw their hands in the air and start going out and trying to do things they would do normally. Yeah, so it all starts getting very messy. I mean, UK, the numbers here, as I mentioned, they are really amongst the worst in Europe at the moment. They've just about started to come down now. Of course, as we record this, we have a third lockdown in place anyway. And just yesterday, the government was intimating that there's too many people flouting the rules. The numbers aren't coming down fast enough, so they may make it even tighter. So again, double dip recession talk is very much gaining ground, as is, interestingly, talk about a possible negative bank rate in the UK. And we don't get MPC meeting from the Bank of England this month. It'll be early next month. But crucially, next month, we'll get updated economic forecasts. And we'll also get results of the bank's consultation with financial companies about, what would be the impact of negative rates on their operations. And if that comes through as indicative of, well, look, OK, we can cope with negative interest rates, then I suspect speculation as we head towards February is going to be more and more, well, look, perhaps this is going to be the first time that UK bank rate goes below zero. So there's, you keep thinking, well, how much lower can interest rates go or easing be undertaken out of Europe? But it still looks as if it could be more to come. Certainly the idea of, reducing quantitative easing or heck knows interest rates going up, that's an awful long way down the road.
Yeah.
I guess
Well, it's interesting that they're going to,
sorry.
for the Fed, it's going to be in the quantitative easing. They're not going to go negative. So if there is the need to increase quantitative easing, that's where it's going to be. They're going to just be buying more bonds.
Let me ask you a question on that front.
Yeah,
In terms of the yield curve, I read something today. I mean, obviously,
yeah,
people always try to come out with stories which explain the data some
right.
way, shape, or form.
They
And
do.
there's talk that someone was saying that, well, perhaps actually the FOMC is quite pleased about the backup we've had, at the longer end of the yield curve over the course of the last few weeks or so. Obviously,
Uh-huh.
we're up about 1.17 on the 10-year now, whatever it is. But anyway, it's been a sharp increase. In actual fact, the Fed's quite happy about this because it tells you that market participants are becoming more confident that policy is working and growth's going to come back. Do you think that's true, or do you think they're actually more concerned about the level now and they'd like to see yields come back down again?
I think that is true to the extent or of inflation. They're targeting inflation really very seriously, perhaps even more than employment. This was because of their experience over the last dozen years, where you had a very low unemployment rate and no inflation. So it became less useful to target employment, and let's just keep rates low and keep stimulating the economy until we do see some kind of response in the inflation. So in as much as higher interest rates could be a signal of future activity, accelerating activity that in turn would increase inflation, that would get things back into normal, or some kind of a system where their policy can be more readable and more intelligible. I think the breakdown of the relationships between employment and inflation is a serious problem when you're trying to manage their existing monetary tools.
Yeah, I think that's exactly right. And I must say it's interesting. Obviously, when you look across Europe, on the ECB bottom line, really, its priority given by the EU treaty, which lays down its what it's supposed to be doing, is very much focused on this current near but short of 2% inflation target. Bank of England ultimately has a pure inflation target, and yet we had one of the senior MPC members from the Bank of England today suggesting that it's going to be a labour market which will be instrumental in terms of where policy goes over the next few months. So I think all sorts of central bankers at the moment are trying to weigh up what on the earth they should really be looking at, what they should be targeting. Should it be multi-targets, single targets? Because they really themselves don't know what to do.
Well, there's another concern. I don't want to go on too much, but that a financial overreach here and overinflation of financial assets could create. And this would be due to monetary policy and due to fiscal policy. This is something that's not really being addressed. It's hinted around from retired people and those guys, retired policymakers on the edges and things like that. But there is a risk that all this stimulus has created this gigantic bubble, and then a crack of a bubble is what we saw 12 years ago. It's the historical relation. It's a historical norm, and then that would be another issue for monetary policy, and that would be a very, very critical problem.
Should Bitcoin and Tesla be where they are? Yes, quite exactly. There's all sorts of things fanning fires at the moment, and it's really going to be potentially a quite fascinating year to see how it all evolves. Watch this space, as they say. Anything else I should be? I'll just quickly mention Brexit, since when do we ever not mention Brexit? But I will make it short. Obviously now Brexit is all there and delivered. The UK is no longer part of the European Union. Well, it hasn't been for the best part of a year now, but it's also no longer part of the customs union or the single European market. But they did, of course, have the trade agreement just before Christmas time. So what's happened so far? Well, of course, a lot of firms stockpiled madly precautionary stocks in anticipation of problems with Brexit really kicking off properly beginning of this year. So it's meant that a lot of the traffic which we'd normally have been seeing between our side of the channel and the continental European side, it hasn't actually emerged. So the traffic flows have been a lot lower than you might normally expect. So it makes it quite hard to judge underlying effects currently. But there is an awful lot of unhappiness about the additional paperwork that lorry drivers and exporters are having to do. So it's going to be quite interesting to see just how well this pans out. I suspect the idea of frictionless trade is long gone.
What about friction between with Scotland. Now I saw now Scotland. I saw that it almost looked like, I don't want to use loaded words, but it looks like a shakedown. They want more money. Where they want compensation. Did you see it? Did you see that? Of
Yeah,
course.
I mean,
So, what do you make of that?
well, the Scots are going to try and get more money if they can do, like the Welsh will and everybody else. But for Scotland, of course, the government must be somewhat scared now that if we see where are the May parliamentary elections in Scotland, if the Scottish Nats, the Scottish National Party, under the First Lady and Nicola Sturgeon, if she actually gets a clean sweep there, which is a possibility, then the first thing she's going to demand is another referendum on independence, either this year or next year. Now, Westminster under Boris Johnson is refusing that, saying it's a once in a generation thing. We had one, excuse me, just a few years ago. So no, you're not having another one. But of course, if they get a clean sweep up there, it may be very difficult to resist that pressure. So who knows? Not that bribery is something you talk about in political circles, of course, but it may be the case that they actually have to direct some additional funds in Scotland's direction
Well,
just to try
yeah.
and keep the referendum calls down.
Well, is there already extra funds going out to Scotland compared to England? I mean, does England feel that?
Well, I suppose if you're English, you tend to think that Scotland fares disproportionately in terms of the net UK budget, if you like. Yes, transfers are made across the border, but it's also the case that Scotland could stand to be hit quite hard by Brexit. They voted very much against Brexit when we go back to the old referendum, and they did that partly because implications for the Scottish economy might be worse than the rest of the region. Well, again, like everything else, I guess time will tell.
Mm-hmm.
Okay. Anything else from your side?
Well, I guess we have the inauguration, and it's on our calendar, the Econoday calendar, and what it means for federal offices and whatnot. So that should be a very important day, and hopefully it'll go without any troubles. And the new administration will be put in place, and new emergency stimulus will be working into this medium-term, in-between period of hard times for a lot of Americans.
Let us hope so, and indeed for the rest of the world. On which cheery note, let's make that it for us today then. On behalf of Mark and myself, thanks as ever for listening. We'll be back next week, and in the meantime, as Mark mentioned, do keep up to date with all the key market moving data and events in Econoday's global economic calendar. We'll see you soon. Bye for now.